Viewers at home, you are welcome to my presentation on disposal of subsidiaries. If you are just coming across this channel for the first time, or if you have not subscribed in the past, please click the red subscribe button and also turn on the notification bell icon so that you don't miss my upcoming videos. If you are a returning subscriber, I say thank you and God bless you. Disposal of subsidiaries. What do we mean by disposal of subsidiaries? Disposal of subsidiaries is the sale of the parent company shareholdings in the subsidiary company. The sale of the parent company shareholding in the subsidiary company. That is disposal of subsidiary. Types of disposal. Types of disposal. We are going to categorize the disposal of subsidiary into two. Number one, we have full disposal. Full disposal. Number two, we have partial disposal. Partial disposal. Full disposal is when the entire shareholdings of the parent company in the subsidiary company is disposed, where the entire shares of the parent company in subsidiary company is sold. That is full disposal. That is everything, 100% is disposed of. So that is full disposal. Partial disposal is where part of the parent company shareholding in the subsidiary company is sold. That is partial disposal. We are going to categorize partial disposal into three. One, disposal that result in loss of control. Loss of control, that is where control is lost. Then, disposal where significant influence is retained. Significant influence is retained. Retained. That is where significant influence is retained. This is where control is lost. And the third one is where control is retained. Where control is retained. So we are going to categorize this partial disposal into three. Where control is lost, where significant influence is retained, and where control is retained. Disposal that leads to loss of control, meaning that if the parent company holding in subsidiary, if it is 80%, the parent company might decide to sell 50% or let's say 70% of this. That means if 70% is disposed, then only 10% will be remaining. That is simple investment. That is where control is lost. This 10% is not sufficient to give the parent company the control of the subsidiary companies again. So that is where control is lost. The second one is where significant influence is retained. They be reducing the parent company holding from 80% to 30%, or from 80% to 20%. That is significant influence. 30% is not enough to give the parent company control of the subsidiary, but the 30% is sufficient to give them a significant influence of the subsidiary. And the third one is where control is retained. Maybe reducing the parent company holding from 80% to 60%. Meaning that the entity will still serve as the parent, but they've reduced the holding from 80% to 60%. This type of transaction, we call it equity adjustment. This is equity adjustment. That is the transaction between owners in their capacity as the owners. These are the different, these are the categories of partial disposal. Now, I want to examine the procedures or steps to follow when consolidating the subsidiary disposed. That is disposal of subsidiaries. So, what are the procedures? consolidation procedures. The first thing is to draw the group structure as usual. Draw the group structure. So you want to establish the group relationship. So the second step is to present the summary of the subsidiary net asset at 1, or let me say A, date of acquisition, 2, or B, date of disposal. We are going to have the summary of the net asset at the date of acquisition and the date of the disposal. Date of acquisition, DOA, date of disposal, DOD. Step 3 is to calculate goodwill on acquisition of the subsidiary. Calculate goodwill on acquisition of the subsidiary. Calculate goodwill on acquisition of subsidiary. The fourth step, step number 4, is to calculate the NCI at the disposal date. Calculate the non-controlling interest. Controlling interest at the date of disposal. Date of disposal. Calculate the NCI at the date of disposal. How do you calculate that? So, NCI at the date of disposal, you start with NCI at acquisition, whether fair value or proportionally share of net asset. NCI, share or post acquisition retained earnings of subsidiary up to the date of disposal. The post-acquisition retained earnings you are going to consider will be the retained earnings from acquisition to the date of disposal. Then, where the NCI is proportional, you know, this will be, you apply the percentage attributable to NCI to the net asset at the date of acquisition here. So, you also have share of post-acquisition retained earnings. But where the policy is fair value, you have the fair value of NCI, then share of post-acquisition retained earnings up to the date of disposal. Then where the policy is fair value, if there is impairment, loss, so we are going to have NCI share of impairment, loss. So remove that. So this will give you the non-controlling interest at the disposal date. Step number 5. Calculate the profit or loss on disposal. Calculate the profit or loss on disposal to be included in the retained earnings, in the consolidated retained earnings. So this step number 6. Before step number 6, how do you calculate the profit or loss on disposal? Profit or loss on disposal. So you have the sales proceeds. Sales proceeds, the amount realized from the sales of the parent company shareholding in the subsidiary company. Then we also have fair value of investment retained. The fair value of the investment retained will be added. Fair value of the investment retained. Then we now less net assets of the subsidiary at the disposal date. Net assets of S at date of disposal. From this net asset, we now less NCI, non-controlling interest, calculated in step number 4. NCI, that is from the step number 4. So when you less that, then we now have unimpaired goodwill. The goodwill we have calculated earlier after charging the impairment loss. So the sum of these will now be deducted from the total above. So you have the profit or loss on disposal. So that is step number 5. Profit or loss on disposal of the subsidiary. That is step 5. Step 6. Prepare the consolidated statement, consolidated financial statements. Prepare the consolidated financial statements. Impact of the disposal. Impact of the disposal on the financial statements. Statements. Number 1, what are the impacts of the disposal on the statement of profit or loss? Statement of profit or loss. Impact of disposal on the statement of profit or loss. So, you are going to consolidate the subsidiary disposed up to the date of disposal. 1. Consolidate the subsidiary disposed up to the date of disposal. That is the retainer and the revenue, the expenses of the subsidiary, the tax and others. You are going to consider them up to the date of disposal. So meaning that you are going to apply time apportionment to the items in the statement of profit or loss. You are going to consolidate them up to the date of disposal. Step 2 is to consolidate the gain or loss on disposal. Consolidate the gain or loss on disposal. These are the steps you need to follow when consolidating the statement of profit or loss. So these are the impact of the subsidiary disposed on the consolidated statement of profit or loss. Number 2, the impact on the statement of financial position. Statement of financial position. These items need to be taken into consideration where control is lost. Where control is lost. That is, in the case of 100 full disposal and the disposal that lead to loss of control. Disposal that leads to loss of control, maybe where significant influence will be retained thereafter. So you are going to apply this. Number one, the subsidiary disposed should not be consolidated. The subsidiary disposed. The subsidiary disposed should not be consolidated. That is, the assets and liabilities of the subsidiary disposed should not be aggregated, should not be added to the assets and liability of the parent company for consolidation purpose. Number two, gain or loss on disposal should be included in the group retained earnings. Gain or loss on disposal should be included in the group retained earnings. So these are the impact of the disposal on the financial statements. So on the consolidated financial statements. So before I consider the disposal of subsidiary where control is retained, I want to take some work example. Example 1. ACCA has had a 60% investment in mailed for several years, using the fair value method to value the non-controlling interest. A quarter of the goodwill has been impaired. The group's year end is 31st December 20x5. A disposal of this investment has been made on 31st of October 20x5. Details are: cost of investment $6,000. Mailed fair value of net assets at acquisition $2,000. Mailed net assets at disposal $3,000. Mailed fair value of NCI at acquisition $1,000. Required. Assuming a full disposal of the holding and proceeds of $10,000, calculate the profit or loss arising in ACCA individual accounts, 2 in the consolidated accounts. This question is obtained from Kaplan ACCA study test. Now let's have the solution. In requirement 1, you have to calculate the profit or loss arising in ACCA individual accounts. ACCA is the parent company. ACCA is the parent company that had 60% investment in mailed. So you want to calculate the profit. ACCA group profit or loss on disposal to ACCA. That is the one that will appear in ACCA individual financial statement. So you have sales proceeds. The sale proceeds of the investment. The sale proceed is $10,000. A full disposal of the holding and proceeds of $10,000. So we have $10,000. Now less the carrying amount of investment. How much was the consideration paid on acquisition of the subsidiary, which is the investment in subsidiaries? So the carrying amount, cost of investment is $6,000, which is the carrying amount. So if you deduct that cost, so you have $4,000. That is the profit or loss That is profit on disposal. This is the amount of profit on disposal that will appear in huge individual financial statements. 2, you have to calculate the profit or loss on disposal that will appear in the consolidated accounts. So we have profit or loss on disposal to the group, the one that will appear in the consolidated accounts. So we have sales proceeds, which is still the same amount. Sales proceeds of $10,000. Then less, number 1, net assets at the date of disposal. How much is the net asset? Back to the question. Mailed fair value of net asset at acquisition is $2,000. Mailed net asset at disposal, that is $3,000. So we have $3,000. From this net asset, we less non-controlling interest at the date of disposal. So we have to calculate this. Now let me work it here. Working 1, non-controlling interest at the date of disposal. So which will be NCI at acquisition. NCI at acquisition. And on acquisition of subsidiary, how much was the non-controlling interest? You were given fair value of NCI at acquisition, which is $1,000. So NCI at acquisition is $1,000. We now have NCI, share or post acquisition retained earnings of mailed up to date of disposal. The post acquisition, no. The stake of held in mailed is 60%. That means the percentage attributable to NCI is 40%. So we have 40% of post-acquisition retained earnings from the date of acquisition to the date of disposal. No, mailed fair value of net assets at acquisition was $2,000. The net asset was $2,000 at acquisition, and the net asset at the date of disposal was given to be $3,000. That means there has been an increase in net assets by $1,000. That $1,000 increase in net asset is the post-acquisition profit. So we have 40% of 1,000. That will give us 400. So if you add the 400 to 1,000, you have 1,400. Remember, the policy is fair value. You check if there is any impairment. So you were told that the non-controlling interest, a quarter of the goodwill has been impaired. So mailed using the fair value method to value the non-controlling interest, and a quarter of the goodwill has been impaired. Since goodwill has been impaired, that means you are going to charge impairment loss here. So we have impairment loss, NCI share of it, 40%. So meaning that before you can get this impairment loss, you must have known the goodwill on acquisition, so as to know the amount of impairment loss to charge. Since you have been told that a quarter of goodwill has been impaired, now let's calculate the goodwill. Goodwill on acquisition of mailed. To calculate goodwill, we have purchase consideration or consideration transferred Our purchase consideration is given to be $6,000. That is cost of investment, $6,000. So we have 6,000. Then we add the NCI at acquisition. NCI at acquisition. Back to the question. Huge has held its 60% investment in Mild for several years using fair value method to value non-controlling interest. A quarter of the goodwill. How much is the fair value of non-controlling interest? So now we have Mild. Fair value of NCI at acquisition 1,000. So the fair value of non-controlling interest is given to be 1,000. So if you add the 1,000 to 6,000, you have 7,000. Then from this you now less net assets at the date of acquisition. How much is the net asset of Mild at acquisition? Mild fair value of net asset at acquisition, that is given to be 2,000. So you have 2,000. By the time you subtract 2,000 from 7,000, you'll be left with 5,000. That is the goodwill. So you charge your impairment loss. Impairment loss. Back to the question. Now, you were told that a quarter of the goodwill has been impaired. A quarter means 1/4. 1/4 of 5,000. 1/4 of 5,000. So that will give us 1,250. 1,250. By the time you subtract 1,250 from 5,000, the unimpaired goodwill is 3,750. That is our unimpaired goodwill. And that is 3,750. So our impairment loss is 1,250. So we are going to share between parent and NCI. So 40% of 1,250 will be charged against the NCI. I've told you that where the policy is proportional, you don't need to deduct that. So 40% of 1,250, so we have 500. If you subtract 500 from 1,400, you'll be left with 900. 900. That is the NCI at disposal. 900. So you now subtract the NCI from the net asset at the date of disposal. So you'll be left with 2,100. Then you now have unimpaired goodwill. And that has been calculated, and we got 3,750. 3,750 as calculated above. 3,750. So if you add it to 2,100, so we have 5,850. If you subtract 5,850 from 10,000, then you'll be left with 4,150. That is gain or profit on disposal of investment in Mild. So that is the solution. This is the end of the part 1 of my presentation on disposal of subsidiary. In the next part, I will provide a detailed work example using questions from ACCA examination question. Please don't forget to share it with others. God bless you as you do so. Thanks for watching ACCA.